on the May jobs data. We're joined by Lauren Goodwin, who is the New York Life Investments economist and chief market strategist, and Robert Sockin, who is the Citi senior global economist, both joining us now here in studio. Great to see you, and thanks so much for joining on what is a better than expected print, far exceeding what the expectation was coming into this. Lauren, you said in your notes, bad news is not bad news yet. Well, this is good news, and for the markets, it's turning out to be bad news, at least in the pre-market trade.
Yeah, that's right. I think the market, as well as the Fed, were hoping to see a little bit of evidence of softening in the labor market because the other side of the Fed's mandate, inflation, just doesn't stack up against cuts at this stage in this cycle. And to see more confidence that inflation could move lower over time, you'd really like to see the wage numbers look a little lower than we've seen them today. And so this is good news for the economy. Markets have been very focused on growth. So I think that given the earnings backdrop in the economy, we can continue to see the markets take this in stride. But I expect that it will have a major impact on the Fed's decision next week, likely to price in fewer interest rate cuts for the remainder of this year.
How do you think this shapes the Fed's narrative?
It's a great question because I think what we're living through is the challenges of judging the economy in real time with a very mixed set of signals from these data. So much stronger than expected job growth. Typically, I would say payrolls is the best indicator of the underlying health of the labor market, so that's really good news. You're getting some more soft prints within the household survey, so the unemployment rate's been ticking up, but maybe that survey isn't capturing the large migration flows that we're seeing in the economy as well as the payroll survey is. So maybe there's more noise than signal there. But at the same time, a third factor, as Lauren pointed out, that very hot wage growth. And where you're still seeing inflationary pressure is in the services sectors that are more wage intensive. So it's a mixed bag for the Fed. They'll be happy the economy is holding up well, but probably we're looking for some more slowing and some more cooling, especially on the labor wage side.
So then, Robert, what do you think that tells us about the Fed's timeline for cutting? Because Citi for a long while has held that view that the Fed would likely cut in July. Is that still on the table?
Yeah, our U.S. team still has that July cut, kind of based on two factors. One, a softening in the labor market, enough of a softening really that the Fed is getting worried about recession risk, and enough cooling in the inflation numbers to justify cuts and then putting more weight on the employment side of the mandate. I think here with very strong payrolls and hot wage growth, it's going to really challenge that call of July. But that's what it's based on. It's not dead in the water yet, but that's a tough print for that call.
Lauren, can the markets continue to see all-time highs if we don't see the data line up in terms of what would actually what would warrant a cut for the Fed?
I think it's challenging on the tactical front. So until we have another round of data, we get inflation data on Wednesday, another employment report in another month. But with the way that the data sits today, it's challenging to see markets climb infinitely higher. Earnings season is behind us. The markets have seen better than expected results on that front. And as Rob points out, this is frankly a better than expected economic front still. But it's one in which I think the conversation in the market is going to begin to turn towards how much longer, if the Fed holds interest rates where they are, can the underlying economy avoid broader cracks? We're starting to see cracks in lower income consumers, in elements of the credit markets, especially in floating rate credit, that have been absorbed relatively well so far. But the longer you stay in an environment like this, the higher the risk becomes that a future credit cycle would be more pronounced.
What do you think, Robert? Do you agree, just in terms of some of the cracks that are starting to form?
Absolutely. I completely agree with Lauren. We've been highlighting the same type of cracks, lower income consumers, and you're seeing that manifested in higher subprime delinquencies, drained excess COVID savings, that most of those savings still seem to be concentrated now at the higher income end of the spectrum, ongoing tightening in credit conditions and weak credit demand. So all of these factors are in play. Right now, though, the economy has held up surprisingly well given those strains. So I would still note them as yellow warning signs rather than red, but they've been yellow warning signs for over a year, and the longer we stay at these restrictive levels, the higher probability those cracks grow into something more insidious.
Does the Fed do they risk overrunning higher for longer here?
I think that's a real risk, and they're really walking a very delicate tightrope here. They feel that they're restrictive. They feel they haven't seen enough progress on inflation. But the longer that they hold things here, the more of those cracks that we talked about develop. And that's really why if we were seeing a deeper weakening in the labor market, as our U.S. team thought for this report and thinks will happen going forward, that they'll be quick to react to that because they are worried, I think, about how long they can stay here. So yeah, it really, the longer we stay at this place, the more challenging that trade-off becomes for the Fed.
And Lauren, to put your strategist hat on again, I'm curious just in terms of what this means for investors, for our viewers out there, in terms of some of the pressure that we could see on the broader markets here. Clearly, we're seeing that reaction play out in futures activity right now. But that longer term impact, how do you see that playing out? And what are some of the things that investors need to be, I guess, looking for over the next coming weeks?
I'm so glad you asked, because I think that the fact that we're likely to see some market weakness today really isn't a decision-making factor for most investors. And the fact of the matter is that when the economy starts to slow, that can still be a very constructive time for risk assets because of the dynamic where if you see interest rates coming down later in the year, that you have some expected boon from that activity. What we're doing from an investment perspective is acknowledging that risk assets probably do have more room to run in this late stage of the cycle. Until jobless claims really start picking up, we don't tend to see the market react in a recessionary manner, and we're not seeing recessionary data today. In the environment, though, that we have where valuations are high, we think that this sort of late stage cycle is a really good opportunity to rebalance. So take some gains in large cap US growth equity, deploy them in international equity, maybe even deploy them in fixed income, which is one of our favorite plays, because you can take some equity-like risk in asset classes like high yield while gathering a high coupon with rates at the levels that they are.
All right, Lauren Goodwin, New York Life investments economist and chief market strategist, along with Robert Sockin, a Citi senior global economist. Thank you both for joining us here today.
Thank you.